So we're going to continue our conversations, and this time we're talking about the risks and returns from investing. So everyone knows that there are risks for when you invest, but there are also returns. And we've talked about in the past, the higher the risk, the higher the potential return. Obviously with high risk, not just comes potentially higher return, there's also the high risk that you have to deal with. So today's presentation will deal with a few things, including these items on the agenda. We will talk about the two components of return and how to calculate return using simple equations. We will also look at the relationship between risk and return, and then we will talk about a few sources of risk. 8 sources have been highlighted in this presentation, or will be highlighted in this presentation. And then we'll also talk about how to measure some risk. And at the end, we will look at some of the returns and risks in some of the financial assets in the past. Okay, so moving on to the how to calculate return. Return is basically looking at yield plus price change. So you have two components of return, and yield is either some kind of income from your investment. So yield can be in the form of dividends, it can be in the form of interest, it can be in the form of rent if you have a real estate property. So it is basically the income component of your return. And then you have price change. Price change is either gain or loss. So this is when you sell. You cannot calculate this before you sell your asset. So it is assuming that you own your asset, you have income coming from your asset, and then you sell it at the end. The easiest way to understand this concept is to think about a real estate property that you own, and you may have rented it. So the rent coming in is your yield, and eventually when you sell it, any gain that you have made is your price change. Yield cannot be negative. So yield can only be zero. Either you have no one paying you rent on this real estate property, or it can be positive. Someone is paying you rent or some kind of income on the asset that you own. Price change, the gain doesn't necessarily have to be a gain. It can be a loss. So price change can be a positive number, a negative number, or a zero. It depends on when you sell it, what kind of market you sell it in, and the timing and so on. So again, yield is the income component, and the price change is either gain or loss. Under the terms of tax, we call the gain capital gain or capital loss. So that is just a tax terminology. In regular finance, you would call it gain or loss. So moving on to sources of risk, there are 8 sources of risk that we can think about. I'm sure some of you are aware of some of them. So let's just go through them very briefly, and then you can take a look at them on your own with these slides. So you have interest rate risk, you've got market risk, you've got inflation risk, you've got business risk, which the 4 risks that are highlighted on this particular slide. And you see that the interest rate, when interest rate changes, there are prices of assets that change. For example, when interest rates go up, prices of bonds tend to go down. When interest rates go up, prices of stocks also have an effect, either short-term or long-term. So there are different ways and reasons for interest rates to affect the price of different assets. So how can a price of a stock be affected? So let's just think about this a bit. So usually the price of a stock is directly linked to the value of the company, including its assets and liabilities and incomes and expenses. So if interest rates go up and the company that you have invested in has lots of loans, which a lot of companies do, which now means that they have to pay more in interest. So that means their future liability has gone up, and it also means that their current expenses have gone up. So liabilities and expenses for a company, when they go up, it negatively affects their assets or their net assets and their net incomes. So that means that the underlying value of the company has decreased because of high interest rates. So that's the relationship that you have to think about when you have investments to think about. However, on the other hand, there are certain investments that go up or the price of them goes up when interest rates go up. So you've got other risks as well. You can think through them and read them, obviously. And the next slide details 4 other risks, and they are financial risk, liquidity risk, exchange rate risk, and country risk. So you may ask, country risk, how does that relate to this? Well, you have to think about the political situation of a country. If a country is not stable, chances are that a lot of companies and people will not invest in that country. So that has an impact on the value or the return of your investments. These types of risks can be categorized into 2 categories. So you've got the general risk, you've got the specific risk. General risk is what is generally looked at as risk that you cannot control as an individual or as a company. Specific risk is for a company only. So you've got market risk, issuer risk, which means this is all equal to each other. You can see by this on this slide. Systematic risk plus non-systematic risk. So some of the systematic risks are those risks that are attributable to the market, the macro factors. These are factors that as an individual you and I do not have a control over, or as a company you cannot really choose to not do anything about. You cannot choose to do anything about it. And then you've got non-systematic risks, where you've got the non-market risks. So companies or you as an investor can decide what to do, or if to take an action or not to take an action. How do you measure risk? Well, simply you measure risk by looking at the standard deviation. So that would be this slide right here. So you're looking at standard deviations as the measurement of risk. And standard deviation is, as you know, it measures how far away the different items are from its mean, from its average. So you're looking at that as the risk, how far the actual returns can be from the average of that security or of that asset over a number of years. So let's go back to what is risk. Risk is the chance that the actual return will be different than the expected return, and that's why you use standard deviations to look at the measurement of risk. Now let me go back to this slide. We were looking at returns earlier. So returns, as you know, can be calculated by using yield plus price change. However, it is much better to use percentages in order to come up with the returns rather than the absolute dollar values. Because if you think about it, someone may make $1,000 based on $1 million investment, and another person may make $5,000 based on a $100,000 investment. So the person who made $1,000 has really made only 0.1%. The person who's made $5,000 has made 5%. So which is a really a big difference. And in another example, you can make $5,000 over $1 million, which is 0.5%, and you can make $1,000 over $10,000, which is 10%. So you've got to think about percentages rather than absolute dollar values. How do you calculate a percentage? Simply, you take the yield plus the price change. PE minus PB stands for price at the ending minus price at the beginning, and you divide that by the price at the beginning, and you come up with the percentage. So price at the ending meaning price when you sell, price at the beginning means price when you buy that asset or that investment, whatever that may be. So we've talked about returns, we've talked about how to measure returns, we've talked about a few risks. We also looked at standard deviation as a measure of risk, and we'll now look at risk premium. So risk premium is the additional return that is expected for the additional risk that you take. So you can look at this formula. It says ERP, which is equity risk premium, equals TR, which is the total return on common stocks, which is what you have invested to make a higher return, because common stock is a riskier investment than savings account, for example, or mutual funds. So TR, total return on common stocks, minus RF, which is the risk-free rate, which is the savings account rate. So if you had a choice of investing your money into savings account or into common stocks. If you were to choose to invest into savings account, you are taking minimal risk, and if you were to choose to invest in common stocks, you are taking a higher risk. So you should get some kind of a return by taking a higher risk. So equity risk premium measures that, and it gives you what kind of return you have made or expected to make based on the investment choice that you have. Now let's take a look at the next, the last slide. This provides you a table, information about the last over 100 years of data. So basically, it proves that the higher the risk, the higher the potential return. You can look at the three types of investments that have been highlighted here. You've got the Canadian common stocks, you have the US common stocks, and you have the Government of Canada bonds. The Government of Canada bonds are risk-free, or as close to risk-free as possible. So you look at their average. Their average over the last 107 years has been 5.28%. And look at the standard deviation, which is their risk factor. It is 4.36%. So look at now the highest risk factor, which is 17.67 for the US common stocks. And that reflects in the next table, in the next column, which states that the return. So you see the US common stocks had the highest risk, and then in turn they have the highest return over the last 107 years. So this proves the fact that the higher the risk, the higher the potential return. And historically, you can look at these examples and samples as well and conclude that. So we have talked about risks, returns, and how to measure risk and how to measure returns, and in this presentation. So hopefully in the next time we'll move on to a new concept. So thank you for listening.